I'm a great proponent of the stock market. So much so, I've often said that investing in shares is a national duty. But many people stay away from investing in stocks because they don't understand how to go about it. Or they say we don't have the time. For such people, the ideal way to be invested in the stock market without taking up any time of theirs is to take the mutual fund route. If a large number of people who don't possess the expertise or are too busy to invest pool in their money in a common fund, and the fund invests collectively on their behalf in bonds and stocks and money market instruments, it can become a mutually beneficial exercise. Since the amount becomes reasonably large, the fund can now hire full time professional managers who can take decisions on behalf of the fund and make regular capital gains or regular returns for the investors. The expenses incurred by the mutual fund are collectively called the expense ratio. Just as there are shares in the stock market, in a mutual fund, there are units. If you divide the market value of the portfolio of the mutual fund by the number of units, you arrive at what is known as the net asset value, the NAV. The NAV represents a unit's market value, and this is the price at which you buy from the fund or sell the units back to the fund. The NAV is calculated at the end of every market day using the closing prices of the portfolio security. Different schemes have different NAVs, and these high or low NAVs in no way reflect the performance of the fund. So a unit of a particular fund may be available at an NAV of 10 and another one may be available at 100. It doesn't mean the one at 100 is more profitable than the one at 10. If you buy for 10 and it becomes 12, and the one that you bought for 100 may become 110, the former has given you a 20% return while the latter has given you a 10% return. On a lighter note, the mutual funds had started in the US many years ago. The whole logic was there were so many companies which were trading on the stock market, and the investors had a tough time where to put their money. So when the mutual funds came into the scene, they said it's easier to put your money in the mutual fund and let the mutual fund decide which companies to make the investments in. But then, in due course of time, so many mutual funds came up that then it became a problem which mutual fund to invest in. In India, SEBI divides mutual fund schemes into 4 different categories. You can invest in equity mutual funds, debt mutual funds, hybrid mutual funds, a solution-oriented mutual fund. In an equity mutual fund, obviously, the money invested by you goes into equity shares of various companies. These funds invest directly in stocks. Since equity markets are prone to fluctuations, these are high risk, high return investments. Equity mutual funds are good for those who have a long-term investment horizon. The second category is debt mutual funds. Since debt schemes are not subject to the vagaries of the stock market, these are stable and substantially less risky, but also give you a mediocre return. They are good for people looking for short-term investments, not longer than a 5-year time horizon. The third category is hybrid mutual funds, where the money gets invested in a combination of equity and debt. So the return generated would be somewhat higher than the returns given by pure debt mutual fund. And the fourth category are the solution-oriented mutual funds for specific needs like children's education or post-retirement. These schemes usually have a lock-in period of 5 years. Now, a good way of getting into the mutual funds or investing your money in mutual funds is via the SIP route, systematic investment planning. SIPs allow you to invest a fixed amount at certain regular intervals like weekly or monthly or quarterly, and these help inculcate the savings habit in you. In an SIP, the money gets debited from your account through a standing instruction and it gets invested in mutual fund schemes, and the number of units that you will get will depend upon the NAV of that day. Guys, I recently came across Power Up Money, and I must say I like what they are building. I'm also thankful to them for having sponsored this video. What I like about them is the app goes beyond numbers to explain what is behind them. It focuses on the right numbers, like one of the few apps that show rolling numbers rather than just displaying point to point returns. I've always believed an informed investor is an empowered investor, and it is refreshing to see a company whose philosophy aligns with that. So, yes, I'm a fan. What Power Up Money does is it divides your investments into clear buckets named inform, on track, off track, out of form, with clear actionables on whether you should continue investing in them or not. In case you're looking to begin your mutual fund investing journey or you need help in your existing investment decisions, feel free to look up the Power Up app.
They also have an elite membership which presents a host of features for you. Rebalancing being my favorite because of how unique it is, it gives you a comprehensive rebalancing plan with clear instructions and reasons as to why you should switch from X fund to Y fund.
You know, one of the advantages of taking the SIP route is it gives you the benefit of averaging. A principle of stock market investing is buy low, sell high, but most people land up doing the other way around. But in case of an SIP, if you decided to invest, say, 10,000 every month, now when the prices go high, you will get lesser number of units for the same amount. And when the prices are low, you buy more quantity for the same amount. So you're actually buying when the market is low. You're buying more when the market is low and less when the market is high, which is exactly what you should be doing. But if you are driven by emotions, you may not be able to do so. SIPs also allow you to enjoy the benefit of power of compounding if you are an early and a regular investor. Let's imagine somebody started investing 1,000 rupees per month at age 40, earned an annual rate of return of 8%. At age 65, this person would have accumulated about 9.5 lakh rupees on a total investment of 3 lakhs. Another person had started investing 1,000 rupees at the age of 25, earning 8% per annum and deposited only for 15 years. That means till the age of 40. This person at age 65 would have a balance of 25 lakhs 50,000 plus on a total investment of 180,000. In the first case, the money was invested for 25 years. In the second case, for 15 years. And still in the second case, the money available is almost 3 times as in case 1. Albert Einstein is rumored to have called the power of compounding the most powerful force in the universe. You can make compounding work for you by beginning the saving habit early and saving regularly. And for this, SIP would be a great tool. Thank you for watching. Please do like, share, and subscribe.